Guys, the Trump administration just took a significant stake in this stock. Well, technically it's the Department of Commerce taking an equity stake, but you get the idea. And this ties directly into the largest capital rotation we're about to witness in modern market history. The global currency reset is here, and I'm going to show you exactly how I'm investing in 2026. We're talking about a massive shift where the government is picking winners and losers. Capital is flowing in very specific directions, and most investors are completely missing what's happening. So today's video, we're going to break down exactly what you need to know and how you can position for this. Because when this rotation happens and it's already starting, you either understand where the money is flowing or you watch from the sidelines wondering what just happened. And the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube goes and pushes this video out to more people, which helps us prepare more people for this incredible opportunity. And if you want access to our trade of the day and premium drop-in analysis service, you can try it for just $25 for 7 days at stockscommunity.com. Plus, if you want to get the full transcript of this video and future videos in your inbox, sign up at free.stockscommunity.com in the description below. As always, if you're the one making the actual purchases, the sales, you have to do your own diligence as well. Take your time, be cautious. This is not financial advice. I'm just sharing my research, and you have to make your own decisions. Now let's get into it. Here's what's happening right now that almost nobody is paying attention to. Gold just hit 5,180 per ounce. Silver hit $91.50 last week. These are absolutely historic parabolic moves. Gold is up over 100% from the 2024 lows. Silver's up over 200%. And I'm sitting here looking at this setup and I'm telling you, we are at or very near a very close top to precious metals. I'm not saying they're going to crash completely tomorrow. Silver is already looking pretty bad, but I don't think it's going to be apocalyptic. I'm just saying when you see parabolic moves like this, when you see assets go vertical in a matter of weeks, history tells us what comes next. And more importantly, when these metals correct, and they will correct, that capital doesn't just disappear. It has to go somewhere. And that's where this gets really interesting because we're seeing a massive shift happening right now. The government is taking equity stakes in strategic companies. The Trump administration, or more specifically, various government agencies, are essentially picking winners. They're buying stocks. They're taking ownership positions. And the latest one just dropped in the last few days. But before I get to that, let me explain why this matters for where capital is flowing this week. When I look at the gold chart, I'm seeing classic parabolic exhaustion signals. You've got a beautiful uptrend that's been in place since October. Everything's been working perfectly for the bulls. Gold just marched higher and higher and higher. But now we're hitting resistance zones that matter. The kind of resistance where big money starts taking profits. The volume is concerning too. The move from 4,800 to 5,200 is showing elevated volume, but it's not showing the kind of blow-off euphoric volume you'd need to see if this thing was going to go to 6,000 in the next few days. Silver is even more extreme, a 36% gain in less than a month. It's not a bull market, it's a mania. And when I look at the setup, I'm seeing every warning sign you could possibly want to see before a major move downward. Now, there's going to be a move. It went from 85 to 91. It showed declining volume, not increasing volume. That means the buying is exhausting, and we're already seeing that. And we got a gap up last Friday on some tariff news. What happened? Immediate reversal, a failed breakout. That's smart money distributing to dumb money. And with the further move down in the last few days, the question everyone should be asking is, when gold and silver correct, where does that money go? Because The capital that's been chasing precious metals, and we're talking about billions and billions of dollars, that capital doesn't just sit in cash. Momentum traders don't work that way. They rotate. They look for the next underowned, underloved, asymmetric opportunity. And right now, that's Bitcoin. Bitcoin is trading at $87,000 right now. It's down from its December high of about 108,000. And more importantly, it's been dead money for almost 2 months, while gold and silver have been going absolutely vertical. Most people look at that and they think Bitcoin's broken. The crypto rally is over. Move on. I look at that and I see the exact opposite. I see an asset that's building a base while not being dragged higher by the gold mania. And that decoupling is actually incredibly bullish. See, here's where most people don't understand. This is capital rotation. It's happened over and over throughout the market history. In the 1930s, gold outperformed everything for years. And then eventually, capital rotated into stocks. In the 1970s, commodities had a massive bull market. And then capital rotated into bonds and stocks in the 80s. From 2000 to 2011, gold and commodities absolutely ripped. And then capital rotated into tech stocks from 2009 to 2011. That was a huge move. We're in one of those moments right now. Gold has had its run. Silver has had its run. And the next phase is capital rotating into assets that benefit from the same macro themes but haven't moved yet. And that's Bitcoin. That's Ethereum. That's the quality crypto ecosystem. But let me dig deeper into what's happening with Bitcoin specifically, because this is critical. When I look at the on-chain data, I'm seeing something really interesting. Bitcoin's supply on exchanges is at the lowest level we've seen since 2017. We're talking about less than 2.4 million Bitcoins sitting on exchanges available to be sold. That's only about 12% of total supply. Compare that to 2020 when it was over 15%. What does that tell you? It tells you that long-term holders are pulling their coins off exchanges and putting them into cold storage. They're not looking to sell. And when I look at the whale addresses, the addresses holding over 1,000 Bitcoin, they've been accumulating steadily since November. No distribution, no selling, just steady accumulation. These are the smart money wallets. These are the people who bought Bitcoin at $3,000 in 2018 and held through the entire cycle. They're not dumb money. And they're buying right now at 87,000. The institutional picture is even more interesting. The spot Bitcoin ETFs that launched in January 2024, they've accumulated over 1 million Bitcoin. That's about 5% of total supply locked up in these products. BlackRock's IBIT alone owns over 400,000 Bitcoin. Fidelity's FBTC holds over 200,000. And here's the key. The inflows haven't stopped. They've slowed down from the initial mania, but they're still positive, still steady accumulation. Now, compare that to what's happening in gold. Gold ETFs have actually seen outflows recently. GLD, the big gold ETF, has seen redemptions. That's distribution. That's smart money taking profits. Meanwhile, Bitcoin ETFs are still seeing inflows. That's accumulation. That divergence is telling you everything you need to know about where institutional money thinks the next move is. Let me also talk about Bitcoin's supply dynamics. We just had the halving in April 2024 that cut the new supply of Bitcoin being created every day from 900 coins to 450 coins. That's $6.5 million worth of new supply per day at current prices. Compare that to gold, where we mine about $90 million worth per day. Bitcoin's new supply is a rounding error. And here's what's really interesting. The amount of Bitcoin that needs to be bought just to absorb that new supply is tiny. If you've got institutional demand of even $50 million a day, which is nothing for these guys, you're soaking up all the new supply and then some. That creates upward price pressure. And when you combine that with exchange balances at multi-year lows, you've got a supply squeeze setting up. Now, let me connect this to the broader macro picture because everything is interconnected. We've got 5 major floods of capital coming into the financial system over the next 6 to 12 months. But before I get to those, I need to talk about something that's happening right now that's affecting where capital is flowing. The AI CapEx cycle is starting to show some cracks. You've got companies like CoreWeave that are building massive data centers. They need billions of dollars to build out capacity. Where does that money come from? A lot of it comes from debt. They borrow heavily to build infrastructure. And who's their biggest customer? NVIDIA. Who's helping them finance their operations? NVIDIA. It's circular. CoreWeave just got a $2 billion investment from NVIDIA at $87 a share. Sounds great, right? But here's what people are missing. CoreWeave amended their loan covenants on New Year's Eve to allow unlimited equity cures for any failure to service their debt. That's a fancy way of saying they're out of money. And now NVIDIA has to step in to prop them up because NVIDIA needs CoreWeave to keep buying chips. This is happening all across the AI ecosystem. It's not just CoreWeave. You've got circular financing everywhere. The hyperscalers are spending $600 billion on CapEx, but a lot of that is being financed by the chip companies. And they need the orders to justify their valuations. It's a house of cards built on the assumption that AI demand is infinite and that these data centers will eventually be profitable. Now, I'm not saying they won't be. I'm saying the financing model is fragile. And when you combine that with what's happening in private credit, you've got a potential problem. Private credit funds are starting to show cracks. We're seeing write-downs. We're seeing net asset value declines of 15 to 20% in some funds. That's a canary in the coal mine. Why does that matter for Bitcoin? Because when the circular financing in AI starts to unwind, when private credit starts showing real stress, institutions need to reduce risk. They need to deleverage. That means selling. But after that deleveraging is done, after the forced selling subsides, that capital needs to go somewhere safe. And that's where Bitcoin comes in. Bitcoin isn't dependent on circular financing. Bitcoin isn't dependent on corporate debt markets. Bitcoin is self-contained. It's a closed loop system with fixed supply and no counterparty risk. When you're an institution that just got burned on private credit exposure or on over-leveraged AI plays, you look for assets that don't have those dependencies. And that's Bitcoin. Now, let me talk about the 5 floods of capital that are coming. Flood number 1, the Federal Reserve. The Fed ended quantitative tightening in December. They started what they call reserve management purchases. That's just a fancy term for money printing. 40 billion in the first month alone. And over the next 12 to 18 months, they're going to inject trillions. Why? Because the government has a $38 trillion debt problem. Every single day, old bonds mature and new bonds need to be issued. The Fed has to be the buyer of last resort. When there aren't enough natural buyers for government debt, the Fed prints money and buys those bonds. It's not optional, it's mandatory. And all that money has to go somewhere. Flood number 2, rate cuts. Trump's new Fed chair gets confirmed in May. Trump has been very vocal about what he wants. He wants a 1% federal funds rate. Now, the current Fed officials are pushing back. They're saying, we're only going to do one more cut, but that's not what the market is pricing. The market is pricing multiple cuts throughout the year. And when that new chair comes in, we're getting rate cuts, aggressive rate cuts. And when rates fall, capital flows into risk assets. It flows into growth. It flows into scarce digital assets like Bitcoin. Flood number 3, the $20 trillion investment wave. At Davos, Trump announced 18 to 20 trillion in investment commitments. AI infrastructure, data centers, domestic manufacturing, energy, defense. Now, not all of that will materialize, obviously, but the direction is clear. Massive amounts of capital flowing into growth sectors. And guess what benefits from that? Tech stocks, semiconductors, and yes, Bitcoin. Because all of that AI infrastructure, all of those data centers, all of that energy demand, it creates inflation. It creates currency debasement. And Bitcoin benefits from that. Flood number 4, corporate repatriation. The tax bill includes incentives for corporations to bring overseas cash back to the US. We're talking about over $2 trillion held by US companies in foreign accounts. Apple, Microsoft, Google, they're all sitting on massive piles of cash overseas. When that money comes home, what do they do with it? 40% goes to share buybacks, 30% goes to dividends, 20% goes to mergers and acquisitions, and 10% goes to actual investment. All that is bullish for risk assets. All of that creates demand for stocks, for tech, and eventually for crypto as institutional treasuries start adding Bitcoin to their balance sheets. Flood number 5, consumer tax refunds. This is the wave that's coming first. Late February, early March, consumers are going to get massive tax refunds. We're talking about an average of $8,400 per household. And where does that money go? Some of it pays down debt. Some of it goes to discretionary spending. But 20%, according to historical data, goes into savings and investment accounts. That's money flowing into Robinhood, into Schwab, into Fidelity. And what do retail investors buy? They buy stocks they've heard of. Apple, Nvidia, Tesla, and they buy Bitcoin. So when you add all this up, you've got metals at parabolic tops, ready and starting to correct. You've got Bitcoin at a major base after months of consolidation. You've got 5 massive capital waves about to flood the financial system. You've got the Fed pivoting dovish. You've got rate cuts coming. You've got institutional money on the sidelines waiting to deploy. And you've got sentiment in crypto at peak pessimism. That's the setup. Now, let me talk about the timeline because this is critical. I think we're setting up for a crypto bottom by mid-February. Here's the logic. Gold and silver are at parabolic resistance. And when they really correct, and I believe that continues to happen in the next 1 to 3 weeks, that correction typically takes 2 to 4 weeks to play completely out, putting us at mid to late February. Meanwhile, Bitcoin will have been consolidating for 10 to 11 weeks by that point. That's a long base. Here's what I'm watching for the signal. Gold starts breaking down from the current levels. Silver breaks further below key support. When that happens, you're going to see a 2 to 3 week flush in precious metals. And during that flush, Bitcoin is going to start catching a bid. Why? Because that capital has to go somewhere. Momentum traders don't sit in cash. They rotate. And the most obvious rotation is into an asset that's been building a base for 2 months, that's under-owned, that's hated, and that's sitting at a major inflection point. Now, let me talk about how I would think about positioning this. And I'm not telling you what to do. You have to make your own decisions. But here's how I would think about it. If you're sitting on big gains in gold and silver, this would be a very logical time to start taking profits. You don't have to sell everything, but taking some off the table after a 100% or 200% move just makes sense from a risk management perspective. And where would I redeploy that capital? I would be looking at Bitcoin in the 85 to 90,000 zone. We're already in that range. If we get a final flush down to 75 to 80,000, even better. But I think the base is forming right here. And when metals start breaking down, which I think happens in the next couple weeks, Bitcoin is going to catch a bid fast. I would also be looking at quality altcoins that have been absolutely destroyed. Ethereum, Solana, some of the AI crypto plays, these things are down 50, 60, 70% from their highs. And when Bitcoin bottoms and starts its next leg up, these are going to explode. Why? Because retail FOMO. When Bitcoin goes from 87,000 to 120,000, retail piles in, and they don't just buy Bitcoin, they buy everything. That creates a feedback loop. But you want to be positioned before that happens. You don't want to be chasing after Bitcoin at 130 and Ethereum at 6,000. You want to build positions now while everyone is bearish and scared. Now, let me also mention emerging markets, because this is another potential beneficiary of the metals correction. When gold and silver top out, sometimes capital rotates into emerging market equities. Why? Because emerging markets benefit from a weaker dollar. They benefit from lower rates. They benefit from increased risk appetite. So if you're diversifying, emerging markets could be another area to look at. But my primary focus is on Bitcoin because I think that's where the biggest move is going to be. All right. Now, I need to talk about something that happened this last couple of days. It ties into all of this. The government just took an equity stake in another company, USA Rare Earths, ticker symbol USAR. The Department of Commerce announced a massive $1.6 billion deal, $277 million in federal grants, $1.3 billion in loans. And here's the key. They're taking a 10% equity stake, 16 million shares issued directly to the Department of Commerce, plus 17 million warrants, both priced at $17.17 per share, roughly a 25% discount to where it was trading. The stock exploded on the news. It gapped up from the 40s to the 50s. That's a 25% move overnight. And this is the pattern we've been seeing. The government takes a stake in a strategic company. The stock goes parabolic. And then usually you get some profit taking. But here's what's interesting. This isn't the first time the government has done this. They did this with MP Materials back in July. MP got a $400 million investment for a 15% stake. The stock went from $30 to $60. Massive move. But here's what nobody's talking about. Money is now flowing out of MP Materials and into USA Rare Earth. You can see it in the price action. MP has been getting sold off as USAR rips higher, and that makes sense. People who are in MP waiting for the next catalyst, they're rotating into the new shiny object. They're chasing USAR because that's where the momentum is. But here's the thing, MP Materials could get a second wind. Why? Because as the bag holders from USAR sell into this run, as profit taking accelerates, some of that money is going to flow back into MP. MP is not done. MP is still the dominant rare earth company in the US. They produce light rare earths at scale. The government has a 10-year price floor commitment with them. And they're building out processing capacity. USAR is focused on heavy rare earths. That's a different market. Both companies are strategic. Both companies have a government backing. And both companies are likely to benefit as the US tries to reduce dependence on China for critical minerals. So if you're looking at this space, don't just chase USAR at the highs. Keep an eye on MP Materials. If it pulls back to support, that could be an opportunity. The government is not done investing in this sector. China controls 90% of rare earth processing. That's a national security problem. And the Trump administration is addressing it by taking equity stakes in companies that can build out domestic supply chains. This is part of a bigger theme, resource nationalism. Every major power is now racing to secure critical minerals. The US is taking equity stakes. China is weaponizing export controls. Europe is scrambling. The rare earth crunch that happened in April and May of 2025 proved that dependence on China is an existential risk. So we're going to see more of these deals, more government investments, more equity stakes. And the companies that control the full supply chain from mine to magnet are going to command premium valuations. So when I think about where to position capital, I'm thinking about multiple themes. I'm thinking about the rotation out of metals and into Bitcoin. I'm thinking about the government taking stakes in strategic companies. I'm thinking about the AI CapEx cycle potentially winding. down and where that capital goes. I'm talking about the 5 floods of cash coming into the system. All of these things are connected, and they're all pointing to the same conclusion. We're in a massive capital rotation. Assets that have had their run are going to correct. Assets that haven't moved yet are going to explode. And the smart money is positioning now before it's obvious. Let me address the risk because I want you to go into this with eyes wide open. Risk number 1, what if metals don't correct? What if I'm wrong? Gold goes to 6,000 and silver goes up to 120 after this little pullback. Fine. Then the rotation thesis is delayed, but it's not invalidated. Eventually, those parabolic moves correct. They always do. The question is just timing. Risk 2, what if Bitcoin breaks down instead of breaking out? What if we get a flush to 70,000 or 60,000? It's possible, but if that happens, that's actually an even better entry point. The macro thesis doesn't change. The Fed is still cutting rates. Money is still flooding the system. A deeper flush just means a better entry. Risk number 3, geopolitical risk. What if there's a crisis with China and Taiwan? What if there's a major conflict? Okay, that's a real risk, but here's the thing. In a major geopolitical crisis, everything sells off initially, stocks, crypto, all of it. But after the initial panic, capital flows into scarce assets, and Bitcoin is increasingly being seen as digital gold. So even in a crisis scenario, I think Bitcoin ultimately benefits. Risk number 4, regulatory risk. What if the government cracks down on crypto? What if they try to ban it or heavily regulate it? I think that risk is actually decreasing, not increasing. Trump's been very pro-crypto. His administration has an AI and crypto czar signaling support. Spot ETFs have been approved. Institutions are involved. The regulatory environment is actually improving, not getting worse. So when I weigh the risks versus reward, I think the setup is incredibly favorable. You've got metals topping out at parabolic levels. You've got Bitcoin building a base after 2 months of consolidation. You've got massive capital flows coming. You've got the Fed pivoting. You've got the government taking stakes in strategic companies. You've got sentiment washed out. That's when you want to be positioning, not after Bitcoin is already at 130,000 and everyone is bullish again. Now, let me talk about what happens when Bitcoin breaks out of this consolidation. First, you're going to see a move through 95 to 100,000. That's the key level. When that happens, you're going to get algo buying. You're going to get momentum traders piling in. You're going to get short covering from people who've been betting against Bitcoin for the last 2 months. That initial move is going to be fast. We could go from 90,000 to 110 in a matter of days. Then you hit the old high at 108,000. There's going to be some resistance there. People who bought the top are going to want to get out, break even. But here's the thing. If the thesis is right, if capital is rotating out of metals and into Bitcoin, that resistance is going to get absorbed. Why? Because you'll have fresh buying coming in, not weak hands looking to get out, but strong hands looking to get in. Once you clear 108,000 and make a new all-time high, that's when psychology changes. That's when FOMO kicks in. That's when retail starts paying attention again. That's when your neighbor asks you about crypto again. And that's when the real move starts. The measured move is 120 to 130,000. But in a FOMO environment with capital rotating in from metals, I think you could see 140, 150,000. Why? Because Bitcoin doesn't move in a straight line. It moves in waves. And when it's a bull trend, it tends to overshoot. And here's what's really important. When Bitcoin makes a new all-time high, it's not just Bitcoin that moves. The entire crypto market moves. Ethereum, which has been dead money, just like Bitcoin, that's going to catch a massive bid. Solana, which is down 60% from its highs, that's going to rip. All the quality layer ones, all the AI crypto plays, all of that catches fire. Why? Because retail doesn't just buy Bitcoin. Retail buys everything. They see Bitcoin at 140,000 and they think it's expensive. So they look for cheaper alternatives. They buy Ethereum, thinking it's going to 100,000. They buy Solana, thinking it's going to 1,000. The math doesn't matter. That's how retail thinks. And that creates the altcoin season that everyone's been waiting for. Let me also talk about the macro backdrop for Bitcoin, because this is critical. We're entering an environment where governments are printing money at unprecedented rates. The US government is running trillion-dollar deficits. The Fed is going to start cutting rates. Other central banks around the world are already cutting. Japan is stuck with near zero rates. Europe's cutting. China's easing. This is a global coordinated easing cycle. And what benefits from that? Scarce assets, assets that can't be printed. Gold has been the traditional beneficiary of that. But now you have Bitcoin, and Bitcoin is better suited for this environment. Here's another thing to consider. The amount of money in the global financial system is enormous. We're talking about $300 trillion in global financial assets. Stocks, bonds, real estate, commodities, everything. Bitcoin's market cap is about 1.7 trillion. That's less than 1% of global financial assets. If Bitcoin just gets 2%, that's 6 trillion market cap. That's 300,000 per Bitcoin. If it gets to 5%, that's 15 trillion market cap. That's 750,000 per Bitcoin. Now, I'm not saying that happens overnight, but over a 5 to 10 year period, totally realistic, especially as younger generations who prefer Bitcoin come into their earning years and start allocating capital, especially as more countries adopt Bitcoin as a reserve asset, especially as more corporations put Bitcoin on their balance sheets. The trend is clear. Bitcoin is becoming an institutionalized currency. It's becoming a mainstream asset class, and we're still early in that adoption curve. Let me bring this all together. We're at a major inflection point in the markets. Gold is at 5,180, down a little bit. Silver's down a lot at $91 or lower. These parabolic moves historically don't last, and they're starting to crack. And when they correct, that capital is going to rotate, and the most logical destination is Bitcoin. Bitcoin's been consolidating for 2 months at 87,000. It's underowned, it's underloved, sentiment is washed out, and when you've got massive macro tailwinds building, with the Fed pivoting, rates cutting, and trillions of dollars flooding into the system, I think we're setting up for a bottom in crypto by mid-February. And when that bottom is in and Bitcoin breaks out, it's going to be fast and violent. This isn't just a technical breakout, this is a macro rotation. This is institutional money coming off the sidelines. This is the Fed pivoting dovish. This is the next wave of the bull market. So if you're holding big positions in gold and silver, I would seriously consider taking some profits. If you're looking to deploy capital, I would be watching Bitcoin very closely over the next few weeks. And if you're on the sidelines in cash, this could be one of the best entry points we've seen in months. The smart money is positioning now, before the rotation is obvious. By the time CNBC is talking about the capital flowing out of metals and into crypto, the easy money will already be made. Don't be the person watching from the sidelines while others multiply their wealth. Position now while the setup is favorable. And if you want access to our trade of the day and premium drop-in analysis service, head over to stockscommunity.com. Try it for just $25 for 7 days. We break down setups like this every single day. Plus, if you want the full transcript of this video and future videos, sign up at free.stockscommunity.com. The link is in the description below. So what are your thoughts on this rotation thesis? Do you think metals are topping? Do you think Bitcoin is setting up for its next leg? What are your predictions for how this plays out? Let me know in the comments. I love hearing from you. But that caps off today's video. If you found this valuable, smash that like button, subscribe to the channel, share this with somebody who needs to hear it. Because the window is closing. The opportunity is now. And the people who position correctly are going to make serious money in 2026.